how to understand your financial documents and financial projections as a business owner. Now, this is the most intimidating part of starting a company. And it's the most intimidating part of creating your business plan, your executive summary, your go-to-market strategy, your investor presentation, and so much more. But it doesn't have to be intimidating, though, because I teach you how to create and forecast your financial statements from scratch, even if you have no finance and accounting experience, and I make it fun as well. Now, many of the frameworks that I provide my students are financial models. And in my one-on-one calls with students, I help them create their financial models and business plans from scratch. And I help them present with passion so they can ace any interview or presentation. And when it comes to financial statements, it's so much easier than you think. And people get really intimidated by finance, and they get intimidated by financial statements. It's so much easier than you think if you understand it the fun way instead of memorizing it. And when it comes to startups, investors in startups want to see, of course, how much money you'll make in the future. And they want to invest in you if they understand why you need money now. So when you create your financial statements, the loss or losses that you project is the amount of money you need to raise, which I will demonstrate in a second here in a fun exercise. My way is always easy and funner. Now, there's one simple rule that makes creating your financial statement so easy for investors in your startup. This one simple rule is the basic building block when it comes to all of finance, whether you work at Goldman Sachs, a hedge fund, a mutual fund, a venture capital firm, or your startup. This one simple rule is in my hand right here. I can see it. One simple rule. R for revenue. When you sell something, whatever you sell is your revenue. Now, revenue and sales is the same thing. And at the top of your income statement is revenue. So let's build an income statement here together. This will be fun. Okay, we got revenue up there. Okay. And you look at the income statement, and at the top of the income statement is revenue. And in an income statement, people say, what's your top line? Well, at the top of the income statement is revenue. Then at the bottom of your income statement is earnings. And earnings is the same thing as profit and net income. So let's put this earnings at the bottom of our income statement right here. Cool. Then people say, what is your bottom line? Well, the bottom line of your income statement is earnings. So the top line is revenue and the bottom line is earnings. Now, investors say, what is your top line growth? When they say that, they're asking you, what is revenue growing at? Now, in order to go from revenue to earnings, meaning cash in our pocket, we need to calculate expenses. And creating a forecast of future earnings of a company is fun and easy if you remember one simple rule. Creating a forecast of the future earnings of a company is fun and easy if you remember one simple rule. Almost everything is a percent of revenue. Yes, it is that easy. So spend most of your time figuring out what revenue will be. And so let's quickly build an income statement together for year one of our startup. Okay, well, the first expense is the cost of goods sold, COGS, cost of goods sold. And let's pretend that our startup makes iPhones. So my iPhone is sold for $1,000, meaning revenue is $1,000. So what it costs us to make this one phone is $700. That's our cost of goods sold. Okay, so 70% of our revenue is our cost of goods sold. So next up, we have salespeople and marketing people. Okay, and that's called S&M for sales and marketing. And every iPhone we sell costs us $100 in sales and marketing, which is 10% of revenue. All right, let me put this over here. Can you guys see it okay? Good, perfect, awesome. Let's keep building this. Okay, next up we have research and development, R&D, to make the iPhone. And for every iPhone we sell, it costs us $200 in research and development, meaning 20% of revenue. Let's keep stacking this. All right, cool. Almost done here. what about all the other general expenses, like people that work in operations? Well, we're going to put all that stuff in a miscellaneous bucket called G&A, which stands for General and Administrative Expenses. And G&A expenses in our hypothetical example are $100 or 10% of revenue. So let's stack this up here. I think we're done. Okay, cool. Now, let's add up the expenses, okay? So we got $700 here in COGS, that's cost of goods sold, plus $100 sales and marketing, plus $200 for R&D, plus $100 in general administrative. So all this added up together is $1,100 in expenses. So revenue was $1,000, okay, for this iPhone, and our expenses are $1,100. So now we're left with negative $100 in earnings. We're losing $100. And we don't pay taxes as we're losing money. We're losing $100. And if the tax rate is 50%, then we have a $50 tax credit as a net operating loss, or NOL, that we can carry forward. So if we pay taxes in the future, we only pay taxes in the future if we owe more than $50 in taxes. And this will make a lot more sense when we forecast year 2 in a minute. And a quick side note here, if you start your own company and you legally charge stuff to your company by buying the best computer, then you're going to pay less in taxes. And the super wealthy pay less in taxes percent-wise than most people for this and other reasons, which we can talk about another day. And of course, the super wealthy own their own companies. So we're losing $100 here because the iPhone we sold for $1,000 in revenue and expenses were $1,100. So if our investor asks us why we need to raise $100 from an investor for our company, we can explain the use of proceeds. Okay, let's forecast year 2. All right, so in year number 2, we sell 2 iPhones at $1,000 each. So revenue in year 2 is $2,000. Let me stack this up here. Great. All right, cool. Now, the key here is everything is a percent of revenue. So last year in year 1, it cost us $700 for cost of goods sold, okay? And that was 70% of revenue last year. So we're now more efficient in year 2. So here in year 2, our cost of goods sold is going to be 50%. So our cost of goods sold in year 2 is $1,000, which is $2,000 in revenue times 50%. So next up we have R&D. Now last year it was 20% of revenue. And again, what we're trying to do is we're trying to look at everything as a percent of revenue. So 20% of revenue last year was R&D. So now it's going to be, we're going to keep it at 20% because we're growing our company. We want to invest in the future. So 20% times $2,000 in revenue is $400. All right. Next up, we've got sales and marketing. And last year it was 10% of revenue, but this year it's 5% of revenue because we're using automated cloud-based software to sell our products more this year than last year. All right, we're getting some leverage in the model here, guys. Good. All right, so 5% of $2,000 in S&M is $100. Leverage is kicking in. Next up, we've got G&A, which was 10% of revenue last year, and now it's 5% as we outsource some tasks. So 5% of $2,000 is $100. All right. We got real business here, man. We got some leverage too. It's like a baby Drogon for now, but soon it'll be massive. So what are our earnings? Well, here we have $2,000 in revenue for our top line, okay? Minus $100 in G&A. Then we have another $100 in S&M. Then we've got $400 in R&D. And then we've got $1,000 in cost of goods sold. So our expenses in year 2 are $1,600. So revenue of $2,000 minus $1,600 in expenses means we have $400 in pre-tax earnings. So if taxes are 50%, then we pay $200 in taxes. But wait a second. We have a $50 tax loss carry forward from last year. So instead of paying $200 in taxes, which is 50%, okay, which is 50% of $400 in pre-tax income, we're going to pay $150 in taxes, which means that if our pre-tax earnings was $400, we pay $150 in taxes. And this means our tax rate is, Alexa, what is 150 divided by 400?
150 divided by 400 is 0.375.
So it's a lower tax rate. So we paid 37.5% in taxes. You understand the tax carry forward as well. All right, cool. So our earnings here in year 2 are $400 minus $150 in taxes, which is $250. It's pretty simple, and everything is a percent of revenue. So what if you forecast 10 years into the future, and you're not sure if your numbers are believable? Well, of course, the sanity check is your revenue estimate can never be bigger than the total addressable market. So for example, let's say this. Let's say that you forecasted that in 10 years, your revenue is going to be $20 billion. Okay. And what happens is your investor says, that's not realistic, $20 billion in revenue. Well, what you can do is you can say it is, because the size of the total addressable market, is $100 billion. And so your revenue is going to be 20% of the size of the market, the total addressable market. See, it all comes into play here. Yeah. And again, if your investor thinks you're being too positive with your revenue estimate of $20 billion, you could say, well, that's just 20% of the total addressable market of $100 billion. Now, the simple rule is almost everything is a percent of revenue. And in my MBA program, we go into a lot more detail with many tools for you to create your business plan or almost any type of business and finance document.